let's launch into a full-blown breakdown of home equity investment versus HELOC. So this is an honest comparison of two ways to access your home's equity and which one actually fits your situation today. So the two ways to tap your equity, let's really break this down side by side. There's a growing category of products called home equity investments offered by companies like Point, Hometap, Unlock, and Unison. It now sits alongside the more familiar HELOC. Both let you access cash from your home's equity, but they work in fundamentally different ways. So your home equity investment is more like it's like putting an option or a put on your home's value. It's a lump sum cash, share of future value, no monthly payments. And the HELOC, on the other hand, is more like a credit card backed by your home's value. So it's a revolving credit line, interest payments, and you keep all the appreciation down the line. The key here is, as the equity in the home expands with appreciation with a HELOC, you can actually expand that revolving line of credit, typically up to about 80% LTV. So what a home equity investment actually is. This is not a loan. There's no interest rate, no required monthly payment. Instead, you give up a portion of your home's future value in exchange for cash today. You receive a lump sum, company gives you cash up front today. You give up a future share, you exchange a stake in your home's future value, not a monthly payment. And there's no monthly obligation, so no payments during the term, which runs 10 to 30 years, and you settle at the end. You pay out when you sell, refinance, or term expires. So what that share actually tends to look like. These numbers come from regulator disclosures and provider terms. The effective cost of this cash, if your home appreciates meaningfully, can end up higher than it first appears. So CFPB published example, a homeowner receives a 10% of home value in cash in exchange for a 20% stake, so a 2 times multiple on future value. Hometap 2026 terms are a two-tier multiplier of 1.65 to 1.8 times with an 18% compounded monthly cost cap applied. So the risk adjustment rate, typically 2 to 30% applied to your home's starting value before the multiplier is calculated. The California DFPI warning, the share of future value owed can run as high as 70% in some agreements. Read closely before signing. So what a HELOC actually is, on the other hand, is a revolving line of credit secured against your home, variable rate, typically, well, it's tied to the prime, so it's typically going to be 7 to 8%. Interest-only payments available during the draw period, maybe even just that first year, to get you in, and you keep 100% of your home's appreciation. What to know? A HELOC costs you interest, not a share of future value. You keep whatever your home gains over time. However, it carries a monthly obligation once drawn. The rate moves with the market, and qualifying requires solid credit and income documentation, which not everyone has available. So, where each one actually makes sense. Neither is universally better. The right answer depends on your credit profile, how long you plan to hold the property, and how much you expect it to appreciate. Choose a home equity investment if you cannot qualify for a HELOC, you do not want a monthly payment, and you need flexibility with no fixed repayment schedule. Other hand, choose a HELOC if you qualify and your home is likely to appreciate significantly, you want to keep all of your equity growth, and you can manage a monthly obligation in your budget. Go check out the Velocity Banking video on how to really leverage a HELOC in a smart way. So if you plan to hold long-term in a strong appreciation market, giving up a fixed percentage now can cost more than HELOC interest would have. So see what this looks like with your numbers. If you want an honest look at whether a HELOC fits your situation or how the numbers compare against a home equity investment for your specific property, book a call and we'll look through the actual numbers, not a generic pitch. We'll compare both options side by side for a specific property and situation. And then essentially you're walking away with a game plan, or at least the steps to prepare yourself for whatever setup suits. Visit gapfunded.com/apply to begin. Link in the bio. I'm Mick Wadley, founder of Gap Funded. We're talking days, not weeks. Both tools solve the real problem. Accessing equity without selling your home outright. The right one for you depends on your numbers, not a marketing deadline either way. So home equity investment, it's trade future upside for payment flexibility today, while a HELOC is take on a monthly obligation and keep all of your equity. The real benefit of a HELOC is only while you're utilizing that money does it cost you anything, and your decision is driven by your credit, timeline, appreciation expectation, as well as really your goal and the project on the line as to where you're going to be leveraging that money.